Okay, looks like we have as many as we can at this point. I don't want to tie the rest of you up, but I'd like to welcome you to Bucks County's webinar on the positives and negatives of buying a business. My name is Linda Zangrilli. I'm the current chapter chair for Bucks County. Just a few housekeeping options here. You do not have to take notes. We are recording. You will get the recording, and you will also get any slides that are being presented. So just listen, and if you have questions, put them in the Q&A, not the chat. The Q&A at the bottom of the screen, and we will address them at the end of the presentation. If you'll allow me just a few moments to talk about SCORE and what we do and who we are a national nonprofit organization. We are made up of some 350 chapters, approximately 13,000 members all over the United States. Bucks County is comprised of 70 or so members. We serve all of Bucks County as well as Eastern Montgomery County. We have a very, very simple mission, and that is to help small business start, grow, and thrive. We do that through seminars such as this. We do that through free mentoring services. So if you have a business or you're thinking of starting a business and just need to float the idea past somebody and get through the business mechanics of it, please contact us at buckscounty.score.org and request a mentor. We'd be happy to help you with that, or any issues or concerns you may have about whether you should or shouldn't do that. So that's my commercial. I hope you will take advantage of the seminar. We have two very, very knowledgeable people here to talk to you. But first, I'd like to introduce our seminar chair, who unfortunately is having computer issues this morning, but we do see his telephone. So we know he's on the line. His name is Ed Torello, and he's the gentleman that looks for the types of things to present to you. He researches different topics that are of interest, and he's come up with a good one today. So without further ado, I'd like to welcome Ed. Ed, can you take over?
I can, and thank you very much, Linda. And thank you, everyone, for joining us on this webinar that we have. It is going to be very exciting and very interesting. Most of you want to buy a business or are looking to buy a business, and this, I think, will definitely help you to do so. This is one of 35 presentations that we have for our fiscal year of 2020/2021, and next fiscal year, we've got 40 of them planned already. So I think you're going to find that the Bucks County SCORE site is going to be, hopefully, considerable help to you. We have two presenters today. One is Marshall Davis, and Marshall is the CEO of Davis Law. It's actually a Bucks County law firm that serves the Philadelphia area and its suburbs, including, I might add, New Jersey. And he's licensed, obviously, in Pennsylvania, New Jersey, and in two of the federal courts in Pennsylvania. His practice includes business law, commercial transactions, real estate tax assessment appeals, etc. He's amply qualified to handle this story, and I think you're going to find his presentation very interesting. We also have Steve Wilson, who's retired now, but a certified mentor here at Bucks County SCORE. And Steve has had a very long career in, I would say, the wholesale distribution and manufacturing business. And Steve has worked at some very large operations, building them from zero to $50 million in sales. And the most interesting thing is he bought a wholesale distributor of contract to supply material about 30 years ago, built it up from really nothing to a very large operation, and then he sold it and retired. So he actually has extremely good personal experience in the whole purchasing and sale of businesses. So with that, I'm going to turn it over to Steve. You're first, I believe.
Thank you. Yep.
Yeah. Okay. Here you go.
Thank you, Ed. Hello, everyone. I'm going to review buying a business from the start to the finish. There's always exceptions and roadblocks along the way, but this is going to be the major areas in the process of buying a business. They are in order of the way it usually works. I have to talk in generalities here because I don't know what point you are in if you are looking to buy a business. So most of the things that I talk about are usually what you go through during the process of buying a business. I'm going to leave all the legal aspects up to Marshall at the end of my presentation. Are you ready to be a business owner? This webinar will give you a better idea if you are ready. When you're the owner, you will be responsible for everything that comes about in your business. Even though buying is a big risk, it gives you the opportunity to be your own boss and succeed at your pace. Show Me the Money. I think that was a movie years ago. It was a funny movie, but this is where you develop your budget. That's the first thing you want to start doing, is develop the budget that would work for you, leaving some money in your account for any emergency reasons. So first, you're going to look at your savings, what you have, what you think you might have available to buy a business. You want to talk to your family and see if anyone wants to contribute to that fund. Of course, you want to talk to some friends, some close friends that might want to lend you some money that you'll pay back to help you buy a business. You might have a partner in the business. They, of course, will be putting some money in. And then there might be a silent contributor, or you might want to call it a silent partner, that doesn't want to get involved with the management of the business, but thinks your idea might be strong enough for them to invest a little bit of money with you paying them back. That's another source. And of course, the last one is the bank or any other kind of lending institution. If you need to borrow some funds from, let's say, a bank to help you buy a business, you might want to first think about a home equity loan. If you have some equity in your home, it can be a fairly easy process. They don't ask you where that money is going to be used. The interest rates are fairly competitive. It's a good way to borrow some money. And by the way, when you're in business, it's also a great way to have some capital available to you. There are 4 different categories of almost every type of business that you can think of. They fall into either retail, wholesale, service, or manufacturing. If you think about all the different kinds of businesses there are out there, they all, for the most part, fall into those categories. What you want to do after you've created your budget, you want to start thinking what category or a combination of categories you want to try to get involved with. Once you figure that out, then you want to think about what type of industry is the right one for you. So you're trying to match up your skills with a goal of becoming an expert in that field. If you get to that point of being an expert, having a lot of knowledge, your customers will gravitate to your business because they're looking for that expert, looking for that business owner that has all the knowledge to help them buy the right product and go forward. Okay, there's 2 ways to buy a business. The first one I call the private sale. And that's going to be through your networking channels. So you want to find, if you can, the right seller that isn't involved with a business broker, which I'll be talking about in a minute, because they're looking to save the fee that the broker is going to charge them. Now, through any kind of business connections, any personal connections you have, start networking with them. You'll be surprised that once you have a starting idea of what kind of business you want to buy, start connecting with any type of business people that you know of that might help you, that they may know of a business that's up for sale, that might fit your experience. Same thing with your close friends, family. You'll be surprised that they might know of someone thinking of selling a business or already starting to sell a business. Business brokers, if you're not familiar with them, this is the most common method that I know of and that I've used to buy a business and to sell a business. Now, in the business broker industry, there are some that specialize in certain types of sellers and buyers, others that are general to the public. Once you start investigating what brokers you want to start talking to, they will interview you, and then you're going to interview them back. But first, they're going to interview you to see what your budget is, and you've already started to work on that, what type of business you're interested in, and you've already started looking at the categories, you've already started looking at the industries that you think would be of interest to you, that you want to go forward with. They have a very strong list of contacts that they've put together over many years of being in business. So this is where you're more than likely going to find a business that's for sale. You also, though, you want to interview them. You don't want to just accept any broker that comes along. You want to find out what kind of background they have in finance and reviewing financial statements. You want to know, let's just say that you were thinking of buying a restaurant or a bakery or some other type of business. You want to see what kind of contacts they've developed over the years. Have they ever sold anything like that? You have the option of going to other brokers or asking enough questions that they might recommend someone else in their firm that you can work with. The broker is the matchmaker. That's the key thing here. They will do the research for you. They will go out into the industry and look for sellers and bring them to you. Now, they also will stay with you through the whole process. That's another key asset of working with a broker. Even though they are hired by the seller, they want you to go through the process as simple as possible. Now, keep in mind that the seller is the one who pays the fee. The fee is usually about 10% of the ending sale. So the broker is working for the seller and working for you, and they're not making any money until the end result, until the process is done, until the sale is made, and that's when they get 10% of the total purchase of the business. You need to develop a professional team. Excuse me. That team needs to be done as soon as possible. That team is made up of a lawyer, an accountant, a business insurance agent, and a score mentor. So I'd like you to take this seriously, because you don't want to push this back. Even though you haven't found a business yet, you want to contact that lawyer, the accountant, the insurance agent far in advance, talking to them about what you think you're going to be doing, what kind of business you hope to buy, and are they willing to help you when that happens. Don't wait until you find a business and then you're going to be pushed into getting a lawyer and accountant real quick. You want to find a lawyer and an accountant specifically that are familiar with buying small businesses, which I would think generally, or most of the audience is involved with. It takes some time. Oh, by the way, we have a list that we can give you of lawyers, of accountants that would help you if you don't have the connection with one of them. Now, if you have an accountant that already is working on your income tax, which most of you may have, you want to start with that accountant and see, have they ever been involved with a business, in buying a business? If they haven't, then I recommend you start looking for someone that has that kind of experience, especially for them to be a CPA. Same thing with the lawyer. The lawyer needs to have had experience and understands your thinking and what you're looking for, and see if you can have a little bit of a beginning relationship with them, and bring them in when the time occurs, which I'll talk about in a couple minutes. Now, let's go to the business insurance agent. Everyone has some agent that handles your car in your residence. Start with them. Ask them if in their firm or themselves have ever dealt with business insurance. It's quite different than personal insurance. And the liability of a business to cover is so important. The business insurance agent that you find needs to be on board and set you up the first day that you buy a business. You want to cover yourself for any particular issues that come along. So that's really important. And I'll talk about score mentors in a few minutes. Okay, so you get a purchase price on a potential business that a broker comes along with. By the way, that wasn't me when I was a little kid. Is it within your budget? So remember, you've already kind of created your budget already, and you're ready to determine whether the business that the broker comes in with that he's talked to you about, is that going to be within your budget range? Remember, everything is negotiable. In the purchase price, there could be some inventory, there could be a vehicle available, there could be equipment, there's going to be some goodwill. The seller has created a purchase price with those items in mind, and he or she has also determined the value of the business. Now, the value is determined in many different ways, and it's not a simple thing. Probably it's one of the hardest things to do for a seller is to determine the value of the business you're running. There is different formulas to use, and I don't have time to get into all of them today, but that is up to the seller. But you also want to try to find out, and there's no reason why you can't ask the seller, how did you determine the value of your purchase price? Going back to negotiating for a second. So always keep in mind that you want to negotiate everything along the way, and don't accept that first number that the seller is putting out there. It is common for putting down a down payment and having the seller create a note for the balance. Let me explain this a little bit more. Just for example, let's say the business you're looking for is going to be is going to cost $200,000. And you, in your budget, really just have $50,000 to buy this business. You can negotiate with the seller that you can give $50,000 right up front, and you'd like to have a note that he puts up for the balance of $150,000. Now that note, by the way, this is very common, very, very common when you're buying a small business. And I did that myself. The note is between you and the seller. The bank is not involved. There is going to be some interest that the seller is going to want to charge. Should be reasonable, should be in the 3, 4, 5%, maybe 6% range. And then the seller is going to want a security agreement, meaning in case you don't pay off that note on time, or you default in some way, the seller, and he's right to have security on some kind of assets that you own that he can take back and pay off the balance of that note. There was many, many different kinds of security. It could be part of your home. It could be part of the business that you're running. It could be other assets that you own. But they have the right to get that security agreement, which the lawyer will put together. Want to go back to, yeah, okay. So here's the process going, all right? You've developed your budget. You've tried to figure out what kind of business you're going to have. You've looked at the purchase price. You've done some negotiating with them. Now it's time to dive into those seller financials. Now is the time to bring your accountant in full time for him to look at the financials, and yourself to look at the financials that the broker will get for you and will deliver to you. Usually you want to get at least 3 years worth of profit and loss, balance sheet, and cash flow statements, at least looking at the history of this business. You also want to get about 3 years worth of income tax statements. So this is all going to take some time. And that's why usually, all right, it takes about 6 to maybe even up to 12 months to find a business and to go through the whole process. It doesn't happen real quick. And if it does, you're missing something along the process. So you have your accountant. He's going over financial statements for you. You're looking at what he's doing. You're also looking at whether they may have QuickBooks, which is, I think, the most popular system out there. And then there's some other systems out there also that are similar to QuickBooks. You want to look at how that is working for the seller. And here's the key. You want to make sure that there is enough profit that he or she is making right now or potential profit so that it fits into your lifestyle, right? If it doesn't, then that could be a deal breaker. But that's what you're looking at this point, all right? And it's going to take some time. At this point, what I want to do is I want to just take a few minutes and talk about the business that I owned. 35 years ago, my wife and I agreed to purchase a wholesale business. Now, I had the budget all set up. I knew from my previous experience and my work experience that I enjoyed working in the wholesale industry. And I didn't really know at that time what industry I really wanted to get into, but I knew I could handle almost any kind of wholesale business, all right? So I went to a business broker. He had some suggestions for me, and he came up with a business called Molten Ladder. And that old picture that you're looking at is the first manufacturing operation, and it was steam generated back in 1839 up in the Boston area. And it was developed by a family called Molten. And there were three brothers. And they were the first manufacturer in the United States to start and manufacture wood ladders. In 1900, one of the cousins or brothers, I'm not sure when I read some of the history here, came to Philadelphia with the name Molten. They came into the center city and they bought 4 buildings and they started Molten Ladder wholesale while the factory was still going on. The factory would then ship them wood ladders down into Philadelphia, and Molten became synonymous with ladders throughout the entire Delaware Valley into New Jersey, Delaware, and all Pennsylvania. They went up for sale 35 years ago. It was like the 3rd or 4th generation. And I came along with the business broker. It was up for sale and I bought it. Now, I didn't really know much about ladders or scaffolding that they were selling, but I knew how to run a business. I didn't need to have anyone help me very much in how to run a wholesale business with other employees, but I really needed some help in understanding the product line. Here's the thing why I'm telling you this story, right? If you're familiar with how to run retail or manufacturing or get into the service sector or wholesale, but you don't know much about the product line, this is the way I did it. I kept the owner, the seller, on board for just a couple of months to help me through the transition. Now, I wanted to be an expert in that product line. So I learned something from him, but after he left and he was retiring, I then knew that I had to give out excellent customer service, which they did for all the years that they were in business. They were 145 years old by the time when I bought it. So I did my best through my background of learning customer service and how important it is to help people whenever they need products or service. So I worked real hard at that, but at the same time, I asked, and we were selling to the contractor trade, I asked contractors to help me a bit understand the product that they're buying from me. They were so willing to do that because they were getting great service from us on time with a great product. They would share their information and knowledge of the product line. So I learned from them And then I learned more, and I learned on my own, and I became an expert. And by becoming an expert, I then gave safety seminars to a lot of these people. Once you become, or if you can become an expert in the product or service that you're providing, customers will gravitate back to you, right? That you will get a reputation of having the advice, the expert advice that you can give in, and it will be a great selling tool for you. Or mentor. As Linda said, we have about 70 mentors in our chapter, and quite a few of them have some great background in this whole process of going through the purchase of a business. It's so big, it's such an important process, and they'll stay with you each level that you get into as you go through that process, all the way to the closing. Even though you have made contact with a lawyer, which you don't want to start calling the lawyer every single day or every week for all the questions you're going to have through the process. You're going to need them at different times, but you have the mentor there, all right, the SCORE mentor. The same thing with the accountant. The accountant is still working on the financial statements, helping you through that. So the mentor is going to stay with you as long as you have them, right up to the closing and beyond. That's really important, because once you buy a business, you don't want to just shake hands with the mentor and say, thanks a lot. You want that mentor to stay with you as the business is growing. I'm also going to throw in the success story program, because I happen to coordinate the success story program. It's been very good for our chapter. And simply what it is we want to thank and recognize the client if they've started a business or if they've purchased a business. And we do that by way of some social media, by way of newspaper, help them advertise that they're in business and so forth. So that's a good program for us. It's been very successful, and it will continue. All right, now that you have gone through this, a good part of the process, right? And you're getting close. You're finding a business that you want to potentially buy. You're going to go through what's called the due diligence. One of the hardest parts you're going to go through. Before the due diligence, and I'm going to get to it in a minute, all right? You want to make sure that you talk to the seller and get a feel for the industry's future, and also what if there's going to be a continuation of customer needs for your services or for your product. The more you investigate on your own and talk to the seller about it, you'll get that feel for whether this is going to be worthwhile. Same thing with the competition. You're obviously going to ask the seller, what kind of competition do you have? But just don't stop then. You want to do some investigation on your own to see if there's more competition than he or she told you about, which is going to help you determine if there's any brick and mortar competition, if there's big box competition, if there's internet competition, and so forth. You want to find out what kind of reputation that the company has. So talk to them on how they handle different customer service, and make your questions tough. Let's say someone needs something on the weekend or late at night. How do you handle customer service? And how does that relate to your reputation in the marketplace? The seller's training transition. Not all sellers will stay on to help you during the transition. Some of them will just say, okay, we're going to go through the closing and I have other things to do, so it's all up to you. You want to try to negotiate that. You want to try at least to have them stay on for a month or two, or maybe longer, to help you get through that transition, maybe even teach you the products just the way I had to go through it. The business structure. You're going to talk to them, whether it's an S Corp or whether it's an LLC or a C Corp, which Marshall will talk to you about later. But know that business structure, know how many employees are you're going to have, and if there's any subcontractors that the seller is using. In the suppliers agreement, which is also known as the vendors, there may or may not be any written agreements out there. So find out who those sellers are, get the names. Now, you can't contact the sellers at this point or the vendors, but at least you want to get the names. You want to find out how big they are, where do they ship from, how long they've been a vendor of yours, what kinds of terms of sale do they have, is there any extensions in the terms that you're buying from. You want to find all that out, and then you want to talk about the location. Are you satisfied with the location of where they might be? And then you have to talk to the landlord. Well, the landlord doesn't have to take you on as a new buyer. There's nothing that says that. So you want to meet with the landlord. You want to try to get the same lease or rental or whatever is out there. You want to try to get the same deal that they've given, or make a better deal for yourself. You want to make sure that the landlord knows what's going on here, so that when the purchase is made, there's not going to be any interruption by him. When I talk about selling process, ask the seller in specifics, how do they go about selling their service or selling their product? And if you think you can do a better job. Now, here's what I'm going to do with due diligence. Due diligence can make or break your purchase here. We call them deal breakers, because you're going to get into the guts of the business. You're going to find out how this business really ticks. You're going to bring in your accountant to do some of the work, but you've got to understand all the things that are happening in this business. Of course, it depends on whether it's a real small business or a little bit larger. Again, I'm talking in generalities here, but you have the right, all right? You have the right to do all the due diligence, which I'm going to show you in a few seconds. Your right is not to be disputed by the seller. Now, what I'm doing here, because of the time frame involved, is I went through this several times, okay? And I'm showing you quickly 4 slides that I hope you will make copies of. If there's anything you should make copies of in this presentation, please, if you're really serious about buying a business, make a copy of these 4 slides. I put a lot of effort into this. You could Google due diligence and you get 10 different charts or 10 different lists of due diligence, but I've kind of put them all together. These are the most important things. I could spend a whole hour, which we don't have time, going over due diligence, and this is really, really important to keep a copy of if you're ever going to buy a business. So I'm sorry I'm going through this quickly, but there's just so much to do on your part when you get into that due diligence. And that's almost the last part of everything before you start bringing in your attorney, which is now, if everything has worked out well and you've gone through the due diligence and you're satisfied with what you've learned and you're satisfied with all the other questions, now it's time to bring in the attorney. Of course, you're going to start negotiating the deal right now. Not before, but now is that time to bring him in to start working on the buy-sell agreement. Your accountant has just about finished most of his work. You have your funds available. Now is deal time. And the journey is on. Now is the time when the work really starts. And you're the boss, and I'm going to turn this over to Marshall.
Hi, everybody. I'm Marshall Davis. Steve, thank you. That was great. I'm going to just update this. All right. So a quick bit about my background. As they said, I practice in Pennsylvania, New Jersey. My firm is called Davis Law. And I focus on business transactions, so people buying and selling and starting businesses. My undergrad is in accounting. I went to the University of Florida. I worked at a Big Four accounting firm after law school. I went to law school at Temple, where I also earned my MBA and LLM in taxation. And I've had my own firm since 2010. So please, if you have any questions, feel free to send them in the question and answer, and I'll keep my eye on that and try to answer them as we move along. Usually when I do this in person, it's a bit more interactive and asking questions, but so I'll try to do that as much as we can, but sometimes it's a little tough on the video conference. So while the attorney does get involved with drafting the documents after due diligence, often, I just want to be clear, the attorney's been involved from the beginning, because to even get to the due diligence point, you need to usually have some sort of document in place. Often there's a confidentiality agreement that the seller is going to want you to sign, that because you don't want the people to know that the business is getting sold. That would be bad for everybody. And then also agreements to keep any proprietary knowledge in place, not to poach their employees if the business doesn't go through, etc. So that's pretty much the first legal document. Once you start hammering out, at least verbally, what the terms of the deal are. After that, once you get the basic business terms down, people will usually have a letter of intent. And they can be binding to some extent, all the way to not binding at all, and they vary significantly. So at a minimum, the letter of intent would either have the price or the formula that's going to be used to calculate the price, any adjustments to the price, whether it's going to be a cash deal, seller financed, bank financed, SBA financed, or any combination thereof. Any major terms, like if there's going to be the seller or key employees staying on to help, that would usually be in there. Any other specifics about key points would be in this document. And then that document would often set a goal for a closing date, which might be a locked in goal, it might be a floating goal, but it's at least something is in there. And that document would usually have the terms for due diligence. If you think about it from the seller's perspective, unless you've got some skin in the game, they're probably not going to want to open up their business to your inspection, their real estate to getting inspected. They're not going to want to give you all their books and records or access to customers unless there's something concrete. So usually there's a deposit that would go with the letter of intent. And I say usually because these things can vary widely. It's contract law, so it's pretty much whatever the parties agree to, we can do. So if you do want to do something different, we can do something different. there's with the deposit, there's usually then a negotiation of how much is the deposit, who's going to hold it in escrow. It's usually either the seller's attorney, the buyer's attorney, or a third party. And what are the terms on that getting refunded? And sometimes there's also multiple deposits. So a basic example would be that gets refunded to the buyer if the seller defaults, if they had some sort of misstatement, if there's an inspection that fails. It would get forfeited often to the seller if the buyer just wants to walk away or in somehow defaults. And there's thousands of different options and variables that can be added into the refundability or forfeitability of the deposit. And that really comes down to the business negotiations of the parties. I often try to look at these transactions from the business standpoint, where it's my goal to facilitate the transaction, to hopefully have the transaction go through, but at the same time to protect my client. My job's not to kill the deal. It's to take the business terms that the parties have agreed to and put them on paper in a way that best protects my client. So when I'm representing the seller, that often means something different than when I'm representing the buyer. One of the things that we talked about was, or that Steve had talked about, was the buying the business as an asset sale versus a stock sale. So there's two main ways that you can buy a business. One is you buy the stock, which is what it sounds like. If it's a corporation, it's the stock. If it's an LLC, it's the membership interests. And you buy that and you own everything. You own the assets, the liabilities, everything. That is less common than asset sales. With asset sales, you usually buy the main assets of the business. So that's the customer lists, real estate, any sort of know-how, proprietary information. If it's a restaurant, it would be recipes. It could be inventory, raw materials, formulas, trademarks, copyrights, patents, all of those things. And then the advantage to the buyer, the main advantage to the buyer, is that you can then decide that you're only going to buy these assets. You're not going to buy liabilities. So there's a little bit more certainty there, because you're not taking over the company and any potential liabilities. You can exclude liabilities or negotiate for some to be included. So there's a little bit of less risk there. There's also different tax treatment for the buyer and seller, which I could give an entire multi-hour presentation on. For the buyer, you've got to worry about what your basis is going to be and how you're going to deduct, depreciate, or amortize the different assets that you're buying. And for the seller, it's going to be the tax impact of the sale. So part of that, that varies significantly between whether there's an asset sale or a stock sale. If for non-tax reasons you want to do a stock sale, you can still elect it to be taxed as an asset sale by doing what's called a 338H10 election, where you can kind of have the best of both worlds depending on what side you are. And if you do an asset sale, you have to actually allocate the purchase price between the assets. And both parties need to agree on that and fill out a form that will get filed with their tax returns that year. And that's because the IRS wants the allocation to be the same, because usually what would be good for the buyer is bad for the seller, and what's good for the seller is bad for the buyer. And basically it evens out as long as both parties treat it the same. That you get in trouble if one party treats it so it's good for them and one party treats it how it's good for them, and then there's a gap and the IRS loses some taxation. So those terms need to be negotiated and agreed, and that's something that gets coordinated with the parties and their accountants. If you do an asset sale, usually you'll be forming a new entity, so you've got a clean slate. And the most common entities are LLCs, or limited liability companies, and corporations. Corporations can be taxed as a C corporation or an S corporation. A C corporation is the traditional corporation. Public companies are C corporations. They're taxed at the corporate level, and then the owners pay tax on any income that they receive as W-2 wages, or any dividends that they receive from there. S corps are a little bit different, where there's not the double taxation, so you're not taxed at the corporate level. Everything flows through to the owners of the business. And an LLC is more similar to an S corp in that, from a tax perspective, in that it, if there's only one owner, it's taxed as a disregarded entity, so the owner would file a Schedule C. And if there is more than one owner, it gets taxed as a partnership. So again, it doesn't have a tax on its own level. The tax attributes flow through to the owner, similar to an S corp. Another tax advantage of an LLC is that you can have that default disregarded entity or partnership tax status, or you can actually elect for it to be taxed as a C corp or an S corp. With corporations, they need corporate record books. There's a bit more work informing them. You need formal meeting minutes at the startup and every year between the shareholders. You need director minutes. You need written resolutions if there's going to be large transactions or transactions outside the ordinary course of business. They need to have actual stock certificates and stock registries, whereas an LLC is much more flexible, and a lot of those formal requirements aren't written. Again, I could go into a lot of detail on this. It could almost be its own presentation, but those are the main differences. So usually it's going to be an asset sale, and usually it's going to be an LLC. If there's different entities, you might have, if there's different lines of the business, you might have more than one LLC. If there's real estate involved, often you'll have one LLC buy the real estate and one LLC buy the business. And then you have leases where the real estate LLC will lease the property to the operating company. And that does a few things. It isolates the risk in different buckets, and it also might help with some tax planning because you can pay rent and maybe save some taxes that way. Again, that's a whole other discussion, but we're kind of just highlighting the main points, and then we can go into details if there's specific questions. It does look like there's a question. It says, even on an asset sale, should you have some monies left over in escrow from the seller to cover unexpected liabilities from the past? Is there insurance for this? So that's a great question. So that is something that can be negotiated. And depending on what line of business there is, there could be insurance. There could be what's called a tail policy, which is more common in professional liability. If you're buying a law firm or an accounting firm, a financial planner, there's also other insurances where you can have successor liability coverage. These are great questions for the insurance agents, but they're definitely things that you should think of. And as far as money in escrow, a lot of times there is money left in escrow. Sometimes that's not just liabilities, it's adjustments to the purchase price. So sometimes the purchase price is a formula of X number of dollars, annual revenue times 2 times 3, whatever that formula is. And if you're going to buy it and the business doesn't do as well, sometimes we build in a negotiation where if the certain metrics aren't met, the purchase price is actually reduced. So sometimes that could be kept in escrow. It could be withheld from future payments to the seller. There's a bunch of different ways that you can handle that. And the next thing I'm going to go through is business licenses and permits. So that's something where most businesses have some sort of permits or licensing. If it's a professional firm, they need licenses. If it's various construction, they need licenses. There's permits for the building's use and occupancy. And part of the due diligence process and part of what will be outlined in a letter of intent and represented and warranted in the agreement of sale is that the licenses and permits are transferable or that they're current and everybody's in good standing. So in due diligence, you're going to go and check those things. You'll go to the township or city and make sure that all the licenses are in place, that all the permits are good. And that's where you can have the inspectors on the buildings look at those things. You'll also want to get an environmental inspection, especially if you're buying the building, and start with a phase 1, it's called, and then maybe a phase 2, depending on what the findings are on that. Sometimes there's transactions where, again, the buyer doesn't always want to do a stock sale because then they're buying all the liabilities usually, but sometimes they're going to want to do a stock sale because permits or licenses are transferable, but only if it's in the same company. So I handled a transaction a couple of years ago with a coal mine, and they had not just environmental permits, but also leases, and the closing binder, instead of a 1/4 inch thick for most real estate transactions, was about 1/2 foot thick. And so the buyer wanted to buy the stock because they were going to basically come in, take over the company, and all of that would continue. They wouldn't have to start from scratch. So that's something key to a non-tax issue, a non-liability issue to consider when deciding whether you want to do an asset sale or a stock sale. The next step, once you go through due diligence, is, as Steve said, to start negotiating the buy-sell agreement, which is either an asset purchase agreement or a stock purchase agreement. And that's where it's the job of the lawyers to put the business terms on paper that the parties have agreed to, and to then hammer out all the legal details. These documents on average are 40 to 50 pages in my experience. Sometimes they could be 20. I've seen them over 100. And it depends on the complexity of the deal, the type of business that's getting purchased, etc. And this is where things start to get put into place, as either while due diligence is going on or after due diligence is completed. And one thing actually I want to note on due diligence is, one of the things that's so important, it's almost overlooked because it seems obvious, is making sure that the numbers work. And that's where we'll work with the accountant to make sure that the financial numbers all tie out. And what that means is the tax returns need to match the books, which would be QuickBooks or the POS systems, and everything needs to match. I had a client where I was representing the seller and the buyer, and the buyer didn't want to. They were buying from they were buying a few franchise territories, and one of the franchise territories, long story short, the books didn't work out, and the numbers didn't match, and there were too many gaps. So they ended up not buying that territory, and they bought other territories. And the people who owned that territory were pretty much left out the dust, because now they had a little island, and this new buyer had bought all the territories around them, and they couldn't get the numbers to match. There were a lot of either intentional or just not careful things where the books and records did not match the tax returns. So back to the buy-sell agreement. That's where we're going to negotiate all the details of the transaction, the tax attributes, which specific assets are getting included, which liabilities are included or not included, whether the sellers or key employees are going to be employed by the buyers going forward. That's where we negotiate things with the landlord, with the leases to get transferred or renegotiated. That could also be due during due diligence. And the buy-sell agreement has multiple attachments to it, again, depending on the specifics of the deal. One of the basics is the promissory note. So often the seller has some skin in the game, and they are financing part of the deal. So there's usually the deposit with the letter of intent. Then there's usually a cash payment of some amount at closing. And then the rest of the amount is either paid as a loan to the buyer, or the buyer could get all the cash up front, and it's a loan that or get paid to the seller, or it's a cash payment up front that the seller would get, where the buyer gets financing from a bank or the SBA. So that in either case, unless it's 100% cash deal, there's going to be a promissory note that outlines the terms of payment. So is there a prepayment penalty? What's the interest rate? How many years is it going to be paid off? Are there credits on that if different metrics aren't met in the business that the seller advertised? And the note is then secured by what's called a security agreement. And a security agreement basically means that if there's a default, how does the seller get their money? Well, that's, as Steve touched on, that is protected by assets. So there's different types of security agreements. You've all probably heard of a mortgage. That's basically a security agreement on real estate. So there's also UCC1 filings, which are security agreements on the business assets. Usually we'll have an agreement where if the buyer defaults, there's a take back provision where the seller can take the business back. So we could use all of these different types of security, a combination of them, just one of them. And again, that's into the negotiations. Obviously, if I'm representing the buyer, we don't want to have a mortgage on our personal residence. We don't want to have a personal guarantee, but sometimes that's the only way to make things happen. So there's sometimes pushback. Maybe you can have less guarantees if you put more money down, but that's part of the whole process. There's also usually a bill of sale in an asset agreement, in an asset purchase agreement that lists the assets that are for sale. There is, again, we touched on the personal guarantee, but if there is a personal guarantee, that's going to be a separate document. So a personal guarantee is basically saying that if the business can't pay for the purchase price or make the payments on the note, then part of the security is the seller can then go after the buyer personally and go after the buyer's personal assets. So that kind of gets around some of the corporate protection that you'd have from using an LLC or corporation to make the purchase. Often with buying a business, you're going to want a non-compete agreement, because a lot of what you're buying, especially with small businesses, are the relationships, the customers. You don't want to go and spend hundreds of thousands or millions of dollars on a business, and then the seller opens up down the street. With that, you'll also usually want a non-solicitation agreement. So the non-compete agreement means that for a certain number of years, within a certain distance, the person is restricted from specific activities that would compete with your business. Non-solicitation means they can go out and do what they want, but they can't solicit your employees or take your customers. So there's usually a non-solicitation and a non-compete agreement that any buyer would usually want the sellers to have. And also along with this, there's going to be, we talked about it earlier, but the tax forms, I usually like them, even though they don't have to be, I usually like them to be attached as exhibits where all the parties actually sign them. And when they sign them, they agree that those are going to be what are filed with their tax returns that year. So I've kind of gone through a lot of this. This would normally be, I could normally do an hour on each of these different topics, but I figure, I'd go through the main points and see if you guys have any questions, and then we can go into more detail on any of the specific points. So if that's okay with everybody else, and Steve, I'm going to open it up for questions for me because I've got about 10 minutes remaining. So if anybody has a question, you can send it in the Q&A, or you can use the hand raise function and ask it out loud.
Okay. Can you hear me, Marshall?
Yes.
And okay. So here's a very interesting question. How do you structure the legal fee if I'm buying a business? Is it by number of hours that you put in, or is it by number of documents and that are required? Because all businesses have a different set of documents based upon what you said, licenses and franchising agreements, etc. How does one, at least in their mind, budget what it would cost to hire a legal team to help them? How do you do that?
Well, a lot of that depends on where the business is located and who the lawyer is. So if the business is located in Bucks County, there's going to be an hourly rate at one level, whereas if it's in Philadelphia or New York, it's going to be a much higher rate, most likely. But generally for these deals, I would do them on an hourly basis because there's not really much of a way to predict. There's no standard agreement. I get this question sometimes where somebody says, well, it's just a standard agreement. Well, no, every one of these deals is different. And even though I've got a huge library of documents on previous deals I've done, and that's what I usually use as a starting point. So I'm not drafting things from scratch. There's so much tweaking and customization that there's not really a way to just say, oh, here's a fixed fee for doing this. I do sometimes see that. That's usually, at least in my experience, it's an attorney dipping their foot into this area where they think that they can do it at a fixed fee, but have never really done it before. Because when the amount of work varies so much, one person's going to either feel like they're way overpaying or getting way underpaid. So that doesn't really work. Sometimes I'll have clients that want to do it on a contingency fee where they don't pay anything unless the transaction goes through. I usually try to avoid that because sometimes the transactions don't go through, and it should be my interest to protect the client, not to make sure the transaction goes through to get paid. So that's where sometimes business brokers might have some conflicts with the attorneys, because the business brokers only want the deal to go through. They get paid their percentage. They don't care if there's liabilities later. They don't care if, from the seller side, they don't care if the buyer defaults later. You know, the purchase price is whatever. They get that 10% at the sale time. So at the same time, attorneys need to be advocates for their clients and fiduciaries. So we try to avoid usually doing a contingency fee for these transactions because you don't want to have an interest that's adverse to your client. That said, sometimes there's flexibility, sometimes that's appropriate, but it's usually these are hourly. And if you're asking for a number, it varies tremendously based on the size of the business, the complexity, and the sophistication of the other side. Believe it or not, if the other side has a good attorney who does these transactions all the time, it is usually lower attorney's fees and a much smoother transaction than if the other side is representing themselves or has an attorney that doesn't do these transactions all the time. And that's because things that are pretty standard and normal in these transactions sometimes raise red flags for people seeing them for the first time. Whereas if you're handling this all the time, it's the normal things to expect. So you avoid a lot of the unnecessary back and forth and hours running up if you can, if both sides have competent representation. Did that answer your question?
Yes, it did. Here's another one. I think this for Steve. Can you explain the working capital model up to the time of sale? Does all the cash leave the business on the sale? Or I assume you would negotiate that a certain amount stays in as part of the purchase price. But what has been your experience?
You say that, can you repeat that again, Ed?
It says, can you explain the working capital model up to the time of sale? I think their real question is, does all the cash leave the business when the sale is completed? Or do you does some of the cash in a sense stay in the business so you can operate the business? Or does the new owner have to put a whole new block of cash in?
Well, he should do he or she should do a couple of things. Number one is always remember to keep a certain part of that in your personal account for any kind of an emergency. And emergencies do come up that you don't expect. You should also have some cash available for immediate working capital. If you give out too much, you know, that starting that first day, you're going to need to start buying some product and in 30 days start paying your vendors. So you got to have a certain percentage of working capital ready for that cash flow. And I think some people have a tendency to forget about that, but you need several months of cash flow handy after you make your purchase so that you're ready to continue business. If that
right. Well, that makes complete sense.
And I would say that in my experience, at least with asset purchases, which is what we normally do, 99% of the time with an asset purchase, the cash is excluded. That's pretty standard. And with a stock sale, usually the cash is excluded. That's usually something cash and cash equivalents are usually excluded. So if you're buying the business for $1 million and they have 100,000 in cash sitting there, you're not going to get the 100,000 in cash. If you were, then they'd be charging you 1.1 million for the business. That's usually
Right.
how it works. But sometimes, again, there's exceptions for everything, especially if there's reserves or something could be negotiated, or now things are crazy because of different downturns. So the buyer might want to negotiate some equity in there. So it really varies, but usually cash is not included in the purchase.
Right. Yeah, that's what I've seen also. But the person asked the question, so I wanted to get your answers. So here's another question. How would it be a logical and reasonable way to value intangible assets such as branding, IP, etc.? I guess you have to put some sort of a value on when you're buying a business, but how do you do that?
So it's a great question, and it's more of an art than it is a science, I say. And the answer varies based on whether you're talking about fair market value, book value, or value for tax purposes. So if it's for the fair market value, then it's the value that a buyer would pay on the market that really should be close to the purchase price. So that's where business appraisers come in. CPAs have formulas that they can use and software that they can use with IRS approved formulas, but those are usually based on looking backwards at the books and maybe making some industry comparisons. Whereas business appraisers really delve a lot more into the business and really look at what the market is locally and regionally, and with a lot more specifics. Now, that said, getting a business appraiser to do a valuation of the business, you're looking at $5,000-$10,000 for most small businesses, whereas it's a couple $100 for the accountant, for a CPA to run it through the formulas. So sometimes people don't want to invest that, but if the purchase price is high enough, they do. But ways to value those assets, it really depends. Coca-Cola's brand is worth billions of dollars for the Coca-Cola logo, but is my Davis Law brand worth that much? I don't know. How much is it worth without me? So that's one of the big things too. How much is the business you're buying worth without the people in it?
Well, here's a sort of a twist on that, which perhaps both of you can answer. Is I already own a business, and my competitor is retiring, and he's offered me his business. How do I evaluate him? I mean, it seems simple on the surface, but is it really?
It's very hard. That comes into trying to value your own business first. If you're similar to that competitor, coming up with a market value, which is a difficult thing to do, but that's one of the ways to do it. And also the goodwill that is in the business, which is, I don't think there's a formula for goodwill that I've read about, but it's part of the purchase price, especially for businesses that have been around for quite a number of years. When I sold my business, and my business at the time was 175 years old, we had a decent amount of goodwill that we put into the purchase price.
Yeah, there's some goodwill that can be accounted for if it's showing up on the books. So if it's been purchased before, so purchased goodwill would show up on the books, but goodwill that you just create usually isn't on the books. So that's where you need these professional valuation people to come in and value it. So a CPA can put a value on it so much, but most CPAs will tell you, if the business, if it's a big question mark, or if it's something unusual or a certain niche business, or if the number's high enough, then you really should be getting a professional valuation company to actually do a full certified independent appraisal. And that's usually not the CPA, because they're not independent, and they're using different tools than the CPA has.
Right.
I saw a question, would you just borrow more from the bank then? I would guess that's if the cash is not included, then yes, you would either borrow more from the bank, or if the bank is involved, they're going to want to make sure that you've got working capital. So it depends on the bank and the deal. You either would need to put that up front, or the bank could finance that.
Right. The bank might require quite a bit of collateral to back a loan of just cash without anything else. Here's a question that's always haunted a number of people. When you're buying a small business, like let's say a pizzeria, a restaurant of that type, or small cash businesses where I'm sure the owner reports every nickel, but there are occasions when they don't. And yet when they go to sell the business, they want to tell you how phenomenal it is, and yet the books don't seem to show it. So how do you make an honest evaluation without, I guess, them saying something and, picking up a free orange suit?
I mean, my position on this, especially when I talk to CPAs who handle these transactions a lot,
right?
You count that as zero because there's no way to prove it. If they're not claiming it, then it doesn't exist. And and people kind of get that. Okay, well, I know it's a pizza shop, they've got cash, but the big question is, well, what expenses are they paying with that cash? It's one thing if that's cash that the owner's taking home, so you can essentially factor that in as more revenue. It's another thing if they're using that cash to pay employees, pay vendors, pay for inventory. So there's no way, if it's cash that they're illegally not accounting for, there's no way to know if that really is a net of, say, $100,000 of cash a year, or if it's been offset by other expenses and it's really nothing. And I've had deals where we've gone through this and we're in due diligence and there's cash, and sometimes we get enough information, sometimes we don't, but a lot of times the people today who are still taking cash are, for whatever reason, paying expenses in cash, which doesn't make sense because then you can't deduct them if you pay them in cash usually, with cash that's not declared. So again, we count it as zero.
Yeah. Okay. It's what I thought. Here's another question: is the person is interested in buying a business, actually a product that is not advertised for sale, but the product has been discontinued by the people who made it. Now, do they write a letter of inquiry, or do they better go to a lawyer or a business broker's office to sort of make the inquiry? How would you go about doing that?
So I think business brokers have their place, but again, as we talked about before, and I could tell a bunch of stories, if you don't need to find the business, if you've already found the business, or if you're the seller and you've already found the buyer, there's not really, in my opinion, much of a need for a business broker. So you're going to somebody's going to end up paying roughly 10% for no reason. So in this case, if you've already got the company identified or the product identified that you want to buy, I'm not really sure what a business broker could do. That's where you can go to an attorney who can represent you anonymously and say, I've got somebody interested in your business. And that's when we can start digging around. And then when you're ready to reveal yourself, then we can let them know who you are. And a good example of that is Disney World. When Walt Disney wanted to build Disney World, he had attorneys buying up all the land through these anonymous shell companies, for lack of a better term, because he knew that if anybody was going to be buying all the swampland in Florida and they knew it was Walt Disney, they'd be selling it for much, much, much more money than they were selling it for. So you often early in the process, you might want to keep it secret who you are, for whatever reason.
Okay. Another question that's interesting, I think, for both of you here. In an acquisition, what is the best way to market the new name? So you've acquired somebody, and now you have your name, and you have their name. What do you do? How do you get out there and let people know it's the same product and or additional products coming?
Well, that depends, and I'll ask the person who asked that. It looks like Pamela, to follow up to this question. Are you saying that you're buying a business from scratch, or you've got an existing business and you're buying a complementary business? Because it's kind of a different answer. Yeah. I'll give you a second to answer that. But if you're buying a business from scratch, you would normally, as long as it's got good reputation and goodwill, you're going to keep it that way. If it's got a bad reputation and you're just trying to buy assets or know-how for whatever reason, then you might want to change that.
I would also suggest that if their reputation is pretty good, that you really buy the name and keep the transition going forward. In our case, I bought the Molten name because it had such a great reputation. It was around for so long. And that really helped me continue the business. If you change the name at the time of the sale, then I think it's harder and you have to start all over again with any kind of social media and put more advertising into it. So I would be more for trying to buy the name.
Agreed. And from a legal perspective, if you're doing an asset sale, like I said, most of these transactions are, and you've got a new entity, it's as simple as just transferring the fictitious name or the existing name to your new entity. So you can still do business and operate under that name.
Yes.
Steve, when you sold your business, the Molson business, did you sold the name also?
I sold the name, especially, I sold the name, but the buyer just changed it slightly, but kept the word Molten because it was so well known.
Right.
And he went from I was an S Corp and he went to an LLC. So he showed that in his name. But basically, the customer then doesn't really think there's anything new. He's still buying from the same company and he still feels comfortable dealing with that company.
When you sold, did you sign some sort of an agreement to stay on for several months, or?
I did sign an agreement to stay on for 3 months, and I did stay on for that long of a period of time. And it helped them a lot, and the transition worked out very well. But again, you don't have to. It could be that some sellers just say, look, I've got other issues and other businesses to run, so I can't stay on, and here's your business at the time of closing.
Okay. But I would always be a little suspicious if people couldn't stay on and help me a little bit.
Yes, you would be. Absolutely.
I would definitely worry about that. Okay. I think we're pretty much at our time, actually. And Pamela did not send a second question in about what you asked her to do.
I do see a comment in the chat, though.
Yeah, I see something in the chat.
From Mike Davis, it says, as a CPA, when I know a client wants to sell, I tell them to eliminate hidden cash for several years prior to putting it up for sale. It's part of the planning. And
here we go.
Exactly.
Okay, I didn't check the chat on that. I was assuming everybody was listening to the.
Yeah, so that kind of goes back to what we were talking about before, that if it's not reported, it shouldn't count.
Right. Yeah. Okay. All right. I guess that is the last of the questions then.
There was also a question about red flags. Did you see that in the chat? What are the red flags when going through due diligence process? Do they happen in the beginning, at the end? And what if the sellers do not honor the non-compete?
Ooh.
There's a lot of red flags.
Yeah,
it could be. I don't even know where I would start the list, but some red flags are financially, if tax returns don't match QuickBooks, if QuickBooks doesn't match the POS system, if you do spot checks on major transactions and they don't match the bank account, you check major checks, check images, and it's written to say a vendor in QuickBooks, but then you look at the actual check image and it's a payment for a charter fishing yacht or something like that. And these are all specific things that I've seen before. Those are all some red flags. Red flags environmentally are anything built before 1978. There could be lead paint, there could be asbestos. So you need to especially check those buildings. Anything that might be residential, there's new environmental laws with lead paint. You need to have the phase 1 environmental done at a minimum. If there's real estate, check for underground oil tanks, leaks, previous types of manufacturing that might have had heavy metals or PFOAs, any of those things. The environmental people will check the history, they'll do soil samples, they'll do all those sorts of things. Those are all very, very important.
I think the summary of that question is that there's red flags that can be right in the beginning, right during the process, and right at the end. That could be so serious that could be a deal breaker.
Yeah.
So that your accountant is really, really important here to take some time. It could take several days, could take several weeks to go through invoicing and billing to vendors and payments. I mean, there's so many of them, and that's why it's called due diligence. And that's why you need a really, really good accountant to help you also go through the due diligence.
Yeah, other flags could be if they don't want you to talk to their employees, even if you have a non-disclosure agreement in place. Well, what are you trying to hide?
Exactly.
There's things in negotiating the purchase agreement that become red flags. And this is where, again, the attorneys sometimes butt heads with the brokers. The brokers often want you to look away, and the attorneys don't, because there could be, okay, well, if you're not agreeing to this representation, or if you're not agreeing to this warranty, then what are you hiding? That's a big concern.
Here's an interesting statement, actually. It says, as a CPA, when I know a client wants to sell, I tell them to eliminate the hidden cash for several years prior to putting it up for sale. Part of planning. I think that's pretty prudent. However, it would be interesting when you look back. Wow, all of a sudden your business took a 35% jump. How'd that happen? That's the interesting question, I think.
Well, and another concern about cash. Sometimes you also need to look at the deposits, because say you're buying a pizza place and there's lots of cash deposits in the register, not necessarily in the bank, but purchases for $50, $100, $20. Well, if you start seeing deposits in their POS system for purchases in the thousands of dollars, is that an owner putting their own cash in just to increase the sales for the years before they're going to sell? Or maybe there's a catering business. But those are where the CPAs are going to drill down and start auditing these things and picking samples to start asking more questions about, to see if there's red flags. There was also a question, what do you do if the sellers don't honor the non-compete? So
that was the other
a lot
part.
of things. I like to build in, if I'm the buyer, that if the non-compete's violated, we get to reduce the purchase price. There's also, you can try to get injunctions if that's part of the agreement. Non-competes are something that courts like to strike down because they feel that in general, people have a right to go out and earn money. So there's a lot of restrictions in order for a non-compete to be valid. It has to be a reasonable amount of time. It needs to be a reasonable geographic limitation. It needs to be limited in scope. So those are all things that you need to make sure that it's a reasonable non-compete. And then when it's time to enforce, then you can either hold back on payments. If there's a seller note, you can take them to court. You can do all sorts of things. A lot of it depends on what's in the agreement. And again, it's why these documents aren't standard.
Right, understood. Well, we're right at our appointed time. I didn't see any more questions in either the chat room or the Q&A. And so what I'm going to do is, first of all, thank both of you. And second, turn it over to Linda, our chapter chair, just for some closing remarks. Linda?
Just wanted to say thank you to both of our speakers for a wonderful presentation. You gave everyone such good information, and of course, you're available. Steve is available to mentor. Marshall's available for his services as well. So I hope you take advantage of both. And of course, if you need mentoring and anything else, you can visit our website, buckscounty.score.org. I thank you all for coming, and we'll see you at our next event. Thank you.
Thank you, Linda. Thank you, Ed.
Thank you, everybody. And I'm sending my contact information in case anybody wants it here.
Great.
Oh, great. Thank you, Marshall. Okay,
I'm
bye-bye.
sending it in the chat.
Okay.
Great.